Hey folks, OSFI comes out with their annual risk outlook for the next for 2024-2025. We're going to get into that. And inflation comes down, but is it reason to celebrate? We're going to discuss all this and take your questions on episode 183 of Ruffled Feathers. Let's get right into the OSFI annual risk outlook. Doesn't look good. So as of February 2024, there is 76% of mortgages coming due in Canada by the end of 2026. A major alarm bell by OSFI because the majority of these folks are going to be experiencing payment shocks, and it's going to be significant to homeowners that took out mortgages between 2020 and 2022. When we were in a low interest rate environment. This is quite concerning to OSFI, especially for those that have high levered properties. They're carrying excess mortgage debt. This is going to be a significant blow to their household budgets. And folks that are in the fixed payment variable product are going to experience even more shock, because they're going to have to revert back to their original amortization remaining on their mortgage. And you have to remember, those folks that had these fixed payment variable mortgages, their payments never changed while interest rates went up, and they went into negative amortizations. And for those that bought right at the end of the cycle, when rates started moving up, they started owing more than what they started with, because the interest payments didn't even cover the principal and interest. Sorry, their payments didn't cover the interest alone. So they weren't making any principal payment reductions. So it's going to be a really sour time when these folks come up for renewal, and they're going to have to make some cash injections to bring their payments down, or see a significant spike in their payments. Now, one of the things that they have been noticing is folks that were in the variable rate products are experiencing more incidents of mortgage arrears. They're seeing a trend, and they think that with the segment of fixed rate mortgages, fixed payment variable mortgages, which comprise about 15% of all mortgages in Canada, we could see more and more delinquencies. And delinquencies just are bad news, because it'll lead to non-performing loans. You're going to see some defaults. You're going to see some loss of you're going to see some increases to credit losses, and we're going to start seeing those delinquency rates start moving up. Now, having said that, in Canada, we've been relatively low on the delinquency front. Traditionally, over the decades, 0.3% delinquency was the norm. We've been significantly under that figure for a while, so we could start inching up to that average and maybe surpassing it by the time this this cohort of renewals comes through to that period of time. Now, if they're sounding the alarms, they're probably of the impression that we're not going to see significant interest rate drops anytime soon. They are calling for some rate cuts by the Bank of Canada, but I don't think it's going to happen soon enough. I think this is going to drag on, and we're never going to see rates where they were during COVID again. At least that's my opinion. But it's going to drag out for a while, and we're going to see people really struggle with their budgets as they see more and more renewals come up at these levels. The problem you have is we're probably going to see some increased unemployment, which further compounds the challenge. And if the delay in rate decreases is profound, it could really make people struggle for quite some time. The April inflation number came in at 2.7%. Everybody's up in arms, celebrating, saying, wow, inflation's been under control. But let's just think about this for a minute. Over the last 3 months, we've seen a reporting of 2.7. In March, it was 2.9, and February was 2.8. Very sticky, okay? Very, very sticky. But I really want to drill into some of these numbers because I always think that the inflation number is designed to help consumer confidence and have a measure of sentiment, okay? So when people hear that inflation is coming down, and we're talking 0.2 in a month, and from February, it's down 0.1, okay? Because in February it was 2.8, we're now at 2.7. So we're only down 0.1 in 2 months, okay? But that 0.1 is a media story. It creates a positive sentiment. But I want to illustrate something as I drill down into how the inflation basket is calculated. And for those of you that have been watching on a regular basis, I talk about the 8 components of the basket that comprises of the CPI index. And the 3 main items are food, shelter, and transportation, okay? Represents almost 60+% of the basket. So those 3 components represent over 60%. Now, food in April, there was some excitement that it was only up 1.4%, okay? Whereas gas went up 6.1% year over year in the month, okay? Now, what's interesting is the weighting of these components is not consistent, okay? So I'm going to just point out something. So last year in April, the basket representing food was 15.94% of the basket. This year, it's 16.65. So it's almost 0.7 higher now than it was last year. And it so happens that food is only up 1.4%. So the weighting is going to be more beneficial this year than it was last year. Now let's talk about shelter. Shelter, we all know interest rates have gone up year over year. Okay, nothing's changed. More and more people are facing higher interest costs, even those coming up for renewal this year. Last year in April, the shelter component represented 29.8% of the basket. Well, this year, in April, it only represents 28.34%, which is almost 1.5% change lower this year than last year. Transportation is also down. Transportation went from 16.91% last year, and now it's 16.44%, which is about half a point. Why do I bring this up? Well, if there's more people on the road with more people having to go back to work from the work from home era, there's more people on the road. There should be more people consuming transportation costs. So there should be a higher component of the basket, okay? When people are spending more money on their mortgage payments and in rent than they were a year ago, the basket composition should have a higher component in shelter, but it's going down. So all these numbers are being manipulated, and it's very interesting to see what they're doing just for that 0.1% decrease, that 0.2% decrease. They're fudging the numbers. Now, some people will say, well, there's a reason for it. You know, there's a weighting and this and that, blah, 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 regional disparities. There's always a reason. But the reality is how the fuck can you calculate inflation when the basket changes all the time? There's no consistency. You need a constant. The constant is, if my basket represents bread, eggs, chicken, milk, gas, rent, blah, 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 it should be evenly weighted so that way I could get a true reflection of what inflation really is. So at the end of the day, in my opinion, I think it's flawed. I think they're cooking the books, and I think they're trying to suggest a positive narrative to change consumer sentiment. Because the reality is everybody is spending more. Everybody has less to spend on themselves and pay their bills and pay their mortgages and buy food. And I think it's bullshit. That's my take on it. So be wary. And what I encourage everybody to do is keep your receipts and know what your personal basket is. So that way you could truly identify what your household inflation rate is, because everybody's basket's totally different. And it's incumbent on you to understand what has gone up by what percentage by tracking what you're spending money on. So at the end of the day, there's trouble brewing. I don't think we're going to see a rate decrease in June. And for those of you that need assistance, reach out. We can help folks with budgets. We can help folks identify how to curb some spending, how to recalibrate your debt loads and all that. We're here to help. So if you do need any assistance in that regard, please reach out. We're here to help. Let's get into your questions and get to a few of them before we wrap it up. What hidden costs should I be aware of when taking out a mortgage? This comes up a lot. People get surprised with certain expenses. When you're taking out a mortgage, there's appraisal costs, there's legal costs. If you're in the alternative space, which is a non-prime mortgage where you have to go into go to a lender that needs to make things work outside of the traditional mortgage approval, there are lender fees, there are broker fees, and when you're dealing with legal fees, there's title insurance that you have to pay for that isn't necessarily in the price the lawyer quotes you. The lawyer always quotes his fees, and then there's disbursements. Disbursements are for searches, for different reports they have to request, and it's not an all-incumbent fee, and it always requires them to know the amount of the mortgage, the value of the home, to get the title insurance quote. So the best thing to do is to try to get an understanding of everything that needs to be paid at time of closing. And in the case of a purchase, there's additional costs that come up beyond the mortgage, and those are land transfer taxes. If you're taking an insured mortgage, there's the provincial sales tax on the insurance premium that's added to the mortgage for high ratio insurance. There's just a plethora of fees, and it's really important that your mortgage professional, your real estate professional, understands what all those fees are so they can explain them to you, so you can be well prepared and maybe even start budgeting for those costs at time of closing, so that way you're not surprised when the lawyer says, hey, you got to come in with a check for X, which represents your deposit and all the closing costs, or if you're refinancing or doing a new mortgage, hey, you're only going to get X. You're not getting the full amount because there's all these fees deducted. And in the case of purchases, you should also be aware that there's going to be adjustments when you're dealing with a new purchase because the previous owner may have already prepaid all the annual property taxes or the condo fees or some type of cost. So you have to reimburse them for the amount of time they're not using the property. So an example would be, you're 9 months in, you're closing October 1st. Clients have paid the full $6,000 in property taxes for the year. Well, they've only used 9 months of it, 75%. So in that case, you have to rebate them $1,500, representing a quarter of the annual property taxes for that year because they've already prepaid them. So these are little things you got to keep in mind, and always be aware that before you go in to see your lawyer, try to get an idea of what is owed. And usually the lawyer gives you a statement of adjustments, and those are things we always go through with our clients to make sure they're aware of all the costs associated with the closing. How do you handle situations where a client's financial circumstances change mid-term? 5 years is a long time. Traditionally, most mortgages are 5-year terms. In today's time, most people are seeking a 3-year term. That seems to be the popular term of choice. But things happen. That's a long time, right? People get sick, people lose their jobs, people have to care for an elderly parent or a sick parent, and they have to take a break from earning income, or their job loss will impact their income. The first thing to do is communicate this, okay? Lenders are very good at helping people out when you're proactive. And it's times like these that I always encourage people to share your problem. When you share your problem with people that care, they're more likely to help you. So, if you lose your job, if something happens, you get sick, the first thing you should do is call your mortgage professional or call your lender and let them know and say, listen, this just happened. I don't know how I'm going to be making future payments. I really need some help. And you'd be surprised at how lenders will come up with solutions or alternatives to give you a hand. So always remember, when something like this happens midterm, communicate it. Don't go into default, don't miss payments, and then ask for forgiveness, okay? Being proactive keeps everybody in a more positive light, and they're not addressing you from a point of weakness where you're already behind the 8 ball, okay? So if in cases where your circumstances change, give your mortgage professional a call your bank, and try to see if you could work out a solution. Maybe it's an abbreviated payment program. Maybe they put you on a note to take whatever you could pay for the time being. And maybe if you're on biweekly accelerated payments, you got extra payments you've made over the time that you've been making payments, and there's some flexibility there where they could give you a hand. So be proactive. That's the best advice I could give you. Why would a realtor suggest to waive a financing condition? No realtor should be asking you to waive a financing condition, okay? We're in a balanced to buyer's market right now. You should be seeking an inspection clause. You should be seeking a financing clause to protect your interest. Anybody who's asking you to waive your financing condition, either you're in a bidding war, a true bidding war, and you want to make sure you can validate that there is multiple offers, and then you make your decision. But I don't like waiving financing clauses because it puts a lot of pressure on that consumer, that buyer, to make sure they got financing, and they may not like the financing thrown at them because they're anticipating getting a prime A lender and excellent rates, and then when they don't qualify, they have to go into the B space or private space where everything costs more. Interest rates are higher, there's fees that people aren't anticipating, and it just sours the relationship between all parties, okay? So I don't think in this market people should be waiving financing conditions. Be very prudent, be very proactive in making sure you get pre-qualified, and always speak to your mortgage professional, your bank, before you put in an offer to make sure you got a sound approval. Not one of these pre-approvals assuming that everything you inputted was correct and then realize that you overstated income because you're self-employed and you showed your gross, not your net, and it's a shit show. Be proactive, get pre-approved, make sure you let your mortgage professional know what offer you're putting in, and you got to protect yourself. I encourage you don't waive it. If you have questions, if you need any help, please reach out to our team. We're here to help you out, and we look forward to seeing you next time. Take care.